In this video, I want to talk about price action and how to avoid stop hunters in the market, because the market is manipulated. If you don't believe me, then I will show you exactly what happens. Many retail traders are using support and resistance to put their trades on without much knowledge or other knowledge which they need, and therefore the institutions, the big dogs, are actually on the hunt for your stops if you're a retail trader. And if you've been stopped out many times using the support and resistance areas, then this video will help you avoid that in the future. So I've been trading for 30 years and I've seen this over and over again. And if you can imagine that across the world, many retail traders are actually trading this way and getting stopped out, and they don't know why. I want to explain exactly what happens. Now, in the first instance, this is the euro dollar, and you might think that this is a double top here, and this is a double top here. So you might want to take a trade there if you're a retail trader, and you put a short here and you put a stop here, and you put your, say, your target down there somewhere, and you wonder why you got stopped out. And there's a very good reason for that, because support and resistance do not work. And I want to show you another very good example. In this instance here, as an example, we can possibly see that there may be a potential buyers coming in, but the stops will be here, just below the support area, because they don't want to lose too much money. Does that sound familiar? If that resonates with you, then I can cure that almost immediately. So the first thing, let me show you this, what's going on here. So we have a support area here on the euro dollar. So you may think, well, okay, the price is going to come down to this support area and bounce up from this support area and then get back to this area here. That seems to make sense, doesn't it? But you have to remember that the institutions are on the hunt for your stops. So let's say you put an order here as an example, right on that line, because you don't want to lose too much money, and you put a nice tight stop in there and you put a target up there, and that looks fantastic. So let's see what happens. So it comes down to your pending position. It comes down to the support line, and you are triggered. So happy days, you're on your way. The problem is they all know where your stops are, and so you're going to get stopped out. So what is the answer to this big problem for many retail traders? As a professional trader, I understand where the stops are. So this is how I would do it. I would forget about support and resistance. Have them on your chart if you wish. So there's a high there, there's a high there, there's a high there, there's a support there. But are they valid? Are the institutions getting ready to take your stops out? Let me show you something. Okay, so what support lines, resistance lines would you choose now? Where would your stop be now? So it's really important to understand where liquidity is. Liquidity, supply, demand is a concept where the institutions know where your stops are, and this avoids that. So let's have a look at this again. So we go back on the same trades as we suspect you might take as a retailer. So double top here becomes invalid, you get stopped out, it moves down. That's why it's failed, because there's no liquidity here. The trade was actually up here into liquidity. I'll change my color in a minute, that color's not very good. Into liquidity, and there's the big move. There's the big move. So this resistance area in red is completely invalid. This resistance area in red is valid, because you have a convergence area where the price is getting ready to fall. Okay, it's already been established from the previous high. The supply zone's already there. supply zone's already there. Now let's look at this one here, where you may have taken the trade because it's a double bottom. Don't like the color. Let's change that color. Let's go blue. So here, you may be tempted to take a trade there, up into there, and then you wonder why you stopped out. Okay, you take a trade here, as I mentioned earlier, but look, there's no liquidity on that line. In order for this trade to be successful, if you did take it, as an example, here, your stop would be way below this support area, demand area. If you don't have the right tools, you won't know where the demand area is. And you can take it to the supply or wherever you want to take it. So understanding that, let's see what happened. So you're stopped out into liquidity zone. And the price makes a profit. And instead of having a couple of trades where you get stopped out and you don't know why, target hit. So this is really important to understand that the stop hunters are out there. They're out for your money. And if you keep getting stopped out over and over again, you need to understand supply and demand. This is really, really important. You can have these lines on here if you want to, the resistance areas and the support areas, but only become important once they hit the demand area, because that's where liquidity is. That's where the big orders are. The other method I want to show you where a lot of people go wrong, and this is really important for retail traders, is to understand that there's a couple of things. Trend lines, how to draw trend lines, and the most important way to draw trend lines is the triple touch, which is really important. So when you draw a trend line, you draw 2 points which join together, these two here, and then you extend them across. And whenever you see this happening, then of course the third touch is the buy order. This is very powerful indeed, and I'm going to show you this in a minute. But where people go wrong quite often on any time frame is that they look out for the break of the trend line and believe it's going to go down and change trends. And it's much more complex than that. Let me wind this forward. So we have we have several times it's touched here. So you've got 1, 2, 3, 4, 5. So the third time it is going to touch, that is the buy. With more information, of course, a break of structure, etc. But let's have a look at this. So the third touch is the most important one. So you can't have 2 touches and buy it because, of course, the trend has not been established. But once you get the third touch, if you join those 2 together, you can see, this is a daily chart, it works on any chart, you can see that the trend has been touched, and that's a really important point of buying orders, like the triple touch, as we say. So what happens after that is really important. I really want you to understand why it's important. So we have a change of trend, or do we? Remember that the trend line is just a guide, and it's one tool which measures your direction. So it's really important to understand this, because many traders, retail traders across the world, will be setting up shorts in this position here. They'll be putting their stops. Remember, the stop hunters are watching. And you put your stop, say, at the top there somewhere, and you put your target down at the bottom of that support line, so-called, okay, for 275 pips. Thank you very much. You can walk away now. You're so confident about this that something is going to happen and it's going to hit your target. But there's something else going on here. The trend line does not give you the full market structure rules. The trend line is not market structure, and it doesn't give you the long-term play on this. So let me show you something. Now, what are you going to do now? Okay, so we can know for a fact that the price is still achieving higher lows. Low there, higher low, and even if it hits this order here, it's still achieving higher lows, and then to move up higher back into the trend. So this is a way for the institutions to grab your stops, because they know that many people across the world, the retailers, retail traders, will be putting in the short orders here. They will see where the stops are, and they'll just take your stop out. Simple as that. That may even, depending on how many stops are up here, use this as liquidity to actually grab onto another trend. Let's play it out. Stopped out. Okay, so understanding that you're drawing the trend lines correctly, that's the first thing. You're buying on the triple touch. Yes, that makes sense with breaker structure. But on the break of the trend lines, if the market structure is still in play, and it is, then of course you are looking for a buy order on your lower time frame. So that's really important to avoid being stopped out and avoiding the stop hunting that goes on every single day across the world. So what do you do in order to grab those profits? Where can you get into the market so that you benefit from that information once you have it? Well, you can just simply come down to the 4-hour chart and come into the buy zone. That might not seem a lot. That's 180 pips there. And also notice the color of the candles bouncing off this order block here, liquidity zone as we call it, going up to this liquidity zone here and the supply zone here at 117. So this looks like there's a long way for this to go before it reaches the target. So top-down analysis using trend formations and chart patterns, allowing for breaks in trends. If you see that going on, become a stop hunter. Do the opposite to what you think you should be doing, and think about, hold on a sec, that's broken. But everyone, if 90% of the world, retail traders out there are selling that, you want to be one of the 10% that are going the other way, because that will be your profits. So going back to the scenario where we have the euro dollar as an example of a fake breakout or a stop hunting mission, if you like, using the support areas can be useful. So if, as an example, in this instance, we see that the price has failed to bounce off this support area, that's really interesting to us. Here at the Trading Mentors, we'll be looking for this every day and sending you the signals if that's what you want. Or we can actually teach you how to do this with lots of skill, and you can get 12 months support and coaching. So as the price comes down, you notice this break here on the support line has failed. The stops are being hunted. But notice here how it comes back in from the demand area, and you can have an order. So instead of having a pending order here, you could have had another pending order on this breaker structure here. So breaker structure is when it achieves a higher high. There, breaker structure, or change of character. There's the breaker structure. Change of character there. So you put on an order just above that, a pending order again, because at this moment you don't know that it's going to bounce. We do because of demand. And you just put an order just above there. You put your stop below there, and you take it to the next level. Just below the supply area is a good idea. So now we can see that the supply area has been hit, and therefore the likelihood of this price actually going down now is very, very high. But we need more information, don't we? So we have to do the top-down analysis. And there's no high in existence now. So we could draw a line from this previous high here and call it resistance. So resistance within a supply zone is highly likely to fall. So what next? We can actually put in a possible order up here for the price to come down, back down into demand here. So we would do something like this, with the stop there just above the previous high. And that's why these are valid. Hopefully you find that helpful.